Just to be clear, you're not necessarily a meme stock expert, but you are a retail trading expert. And this has been an incredible phenomenon to watch throughout the pandemic. Is it here to stay?
I think so. Yeah, I think so. I think if you go back, when day traders are involved in the markets, they do well over time as long as the markets are doing well. You know, a comparable comparison could very well be the late 90s, where we had the dot-com boom, where anybody that was a day trader did very, very well. Then March 2000 through 2003, the world blew up, and the vast majority of those day traders went out of business. I think the difference today is that you've got the Reddit crowd, and you've got people doing a much better job of guiding them. Now, what the Reddit group did a while ago with regard to GameStop, AMC, they put on an incredible trade. But I don't know how much training, I know it's on people's websites, but I don't know how much training the individual, the day trader has gotten when things go very well for them. How do they manage their risk? So if you buy GameStop at 10 and it goes to 50 and you don't take anything off the table, well, who's helping you with that? So they're the concerns that I've got. And I think the pressure on the meme stocks today is a little bit of a recognition.
In fact, they're trying not to help you, right? They're saying diamond hands, don't sell. To the moon, hodl.
Yeah, but that's a mistake. They're not supposed to say that. That's not a good thing for them to say. And I think now what the trading community and the individual investor community is recognizing that these are incredibly overvalued. So use AMC as an example. Their earnings, they're losing money. They're losing a lot of money. But the CEO's been on the air a lot. He talks about the improvements they're making. And while they're still losing money, they're losing a lot less than everybody thought they would. And the stock's down 4 or 5 points. So I don't know if the meme people are shorting those. Yeah, Amanda.
Joe, one of the problems, of course, with these markets is, I used to feel, and I felt this in 2007, I felt it in 99, that you get to a part of the market where it's musical chairs. And everybody knows it's musical chairs, but they're kind of assuming they'll get a chair when the music stops. So they keep going. Now the Fed is providing extra chairs. There is no end to this because, of course, there's no alternative. So when there's never going to be a big asset swap if there's nowhere to go. And even if rates do so-called normalize, it's maybe not enough to draw this amount of capital out of equities. So how do you see this ever ending or correcting or getting back to anything we call fundamentals?
Well, one of the things that took place the other day when the chairman was talking, now the market said everything that he said they were expecting, they were used to. So there was no real move in the market. I actually heard him say for the first time that we are looking at inflation is no longer transitory. Inflation is a real thing. It's above our 2% target. And I think, to me, that at least was the very beginning of an indication that we're going to have to at some point tighten. He wasn't saying that 3 or 4 months ago, and maybe earlier than we had expected. So while it hasn't happened yet, Amanda, I think you make a good point, and that's something we should be sensitive to going forward. Now, asset allocation, fixed income is still not necessarily the place to go. And I'm not talking about real estate, I'm not talking about Bitcoin, and I'm not talking about gold. But within the equity markets, there are opportunities in certain sectors. That's always an opportunity.
Are you seeing any play? By the way, you really focus on an education that traders should get, an education that people on Wall Street Bets or Stock Twits should be getting. Are they getting it from Vlad? Are they getting it from TD Ameritrade? Are they getting it from any of these platforms where they trade?
I think when the online business really first started, the idea was to be able to get as many trades done, do what you can, et cetera. But I think as that developed over the years, especially after the dot-com bubble burst at the beginning of 2000, especially then, there was a much bigger emphasis that we've got to do a better job of taking care of our clients. Now, there's a tremendous emphasis on that in Schwab. I know that for a fact. Certainly TD Ameritrade, I know that for a fact. I think E-Trade, I'm pretty sure of that. But some of the
Robinhood?
I don't think so. And I think Robinhood will make a very big deal. Now, they're still young, but they'll make a very big deal. Oh, no, it's all on our website. It's not easy for an individual investor to be looking at everything on the website and understand it. Then if you have to go to a call center for somebody to explain that, I don't know how many people they have available for that. So I think the Robinhoods of the world, as they develop and as time goes by, they've got to do a better job with education. But education is a priority for a lot of companies now.
Will that include the end of payment for order flow? Where should that go?
Okay, payment for order flow should stay. So why don't we put this in perspective? I'm an individual trader. I want to do a trade. I go through my broker. He winds up going to market maker. The market maker gives him the market is this big. He takes a little piece out of that. And for that, the brokerage firm now comes back and decides whether or not they're going to give a piece of that to price improvement to the individual investor, or they're going to keep part of it themselves. At Schwab, for example, we were similar at TD Ameritrade. We price improved about 95% of the trades that we wind up doing. Now, when the individual investor does that, it's simple. It's easy. They press a button, they put in a couple of things, everything's done. And they're getting that for free. But behind the scenes, there's incredible technology. There's regulatory issues, there's compliance issues, there's operational issues, there's all sorts of things going on, and that costs money. So what happens is, if I'm an individual investor and I'm getting this for free, and I'm getting price improvement, and I'm getting best execution in the marketplace, and I'm getting that for free, somebody's got to pay for that. And that's that little spread that takes place on every trade. And I don't see payment for order flow going away, because I think that would be a disservice to the individual investor.
Do you see, Joe, at some point, stocks going down? You know, I love when somebody on Reddit or somebody on Twitter says stocks never go down. And frankly, if you've been trading this market for 2 or 3 years, like you said, you've done well, right? We're up, the S&P is up 25%, 26% this year to date. We were up 16, 17% last year. We were up like 29% in 2019.
Yeah.
These kids just don't know what it looks like to have a drop. Are we near a real drop? Could we see a real 10, 20, 30% correction?
I think, number one, Matt, I think there is something to be said about experience. You talked about a lot of examples going back in history. Amanda was talking about stuff that took place in 2007. If I'm a 20-something-year-old and I'm just starting, all I've seen is a positive market environment. Same to what happened in the 90s. Now, markets, by the way, in fairness, markets do go up in general over long periods of time. But they don't just go like this. They go like this. And these dips are very, very critical. Sometimes they last a long time. Sometimes they don't. But they're there. And that's why it's critical for the individual investor to be on top of understanding what he or she needs to do as far as risk management. That's the play. The markets are going to go down at some point. We may not know when. I mentioned to Amanda, maybe it's going to be when the Fed starts to actually tighten. At some point they will. I can guarantee that, but I can't guarantee when that's going to happen.